let's talk about CAVA stock. This one is down 22% after hours. Is this one a buying opportunity here? Well, here's the deal with CAVA, okay? The company is pretty exciting. It's I'll say it like this. It's basically a wannabe Chipotle, but for Mediterranean food. If you've been to CAVA, food quality's pretty good, pretty healthy, not pretty cheap. I'll say, you're usually looking to get out of there about $15. That's no drink. Just from what I've experienced. I've been a few times to a few locations now at this point in time over the last 2 years, and it seems like you're looking at about $15 before you buy a drink or additional things or something like that. Okay, so think of it as going to Chipotle, just a little bit more expensive, like maybe $2 to $4 more expensive than Chipotle. Okay, you go up there, you say, I want this, I want this, I want this, I want this, like a Chipotle-like experience. They put it all in a bowl or a pita for you, and boom, there you go. Okay, so this company's grown rapidly. They're building a ton of locations all over the place. Their comp store sales are positive. The results that just came out, I just got a chance to, kind of glimpse over them. It looks like their comp store sales were really weak. It looks like they were in the twos, which is, not where you want to be for CAVA at this stage of the company. You really want to see 5% plus comp restaurant sales, every single quarter, essentially, when you're at the stage CAVA's at. So to be posting a number with a 2 in front of it is not where you want to be for a company at this stage. Like if that's McDonald's, that's fine, but not for a company that's supposed to be like fast growing, all right? So CAVA has an issue there, right? Now, the other issue with CAVA is really around the valuation of this company. Now, keep in mind, the stock's going to go down 20+% likely tomorrow. So the forward P, 2-year forward P are likely coming down. So there's a chance you could get this company tomorrow potentially at a 2-year forward P under 100. Now, might sound attractive, but it's extremely expensive. If you consider something like Cake, right? Cake trades at a 2-year forward P of 14, let's say, right? Cake has two banger concepts. They're going to be expanding all over the United States of America, North Italia and Flower Child, right? Plus a bunch of other concepts that could be coming behind that they're going to be expanding as well. So, you could say, okay, if let's say CAVA was growing revenue at 5x or 6x, what Cake is, then you can say, okay, I could understand CAVA being valued like that. But here's the problem. CAVA is based upon what analysts have here. Analysts have next year's revenue growth for CAVA being somewhere around 17%, right? And they have Cake being around 7%. Well, okay, so a little over 2x. Basically, they have CAVA growing versus Cake. Well, the problem is you're not paying a 2x valuation. You're paying like a 5x or a 6x valuation versus Cake, right? So, that's where you gotta look at the market and you gotta say, okay, where's my money best put for the next 5 years, right? That's what it comes down to. Because I like all, I pulled up 3 stocks here. I like every one of these. I would be happy to invest in all 3 of these. I'd be happy to invest in CAVA. Obviously, I'm a huge Cake shareholder, right? And I'd be happy to invest in Bros. But what it comes down to is where's the money best put, right? And it's not like I can just invest into a million different restaurant plays because there's so many other opportunities in the market. We're talking semiconductors, we're talking tech companies, we're talking tech conglomerates, right? The financials, just random small cap companies. Like there's so many opportunities in the market. So it's not like I want to hold, 6 restaurant stocks. Like 1 or 2 is enough for me. So that's a tough thing there. And then, here's one last thing I'll say about CAVA here before we move on and start talking about these other stocks, okay? I went to this location, 99th and McDowell, probably a month or 2 ago, okay? And it's an interesting location choice, first off, but, I talked to some of my, extended family members about this location because they live in that area. And I said, did you know about this place? They said, yeah, we seen the sign. We had no clue what it was, right? They'd seen it many times, but they had no clue, like, what this place was. And when we went to it, like, peak dinner time, essentially, and it was a ghost town. Like we literally just walked up there and just started ordering. Like there was no line, there was no what you would think there would be for a concept like this. Which means what? It means they have a marketing problem. CAVA doesn't have a food problem. I don't even think they really have a location problem, although it was a kind of a questionable location, I thought. But they got a marketing problem. Like people live in this area, they see this location, they see the sign that says CAVA, and they just have no clue what it is or are interested in going or anything like that because it's like you got to market to people. So it seems to me like CAVA, is really big in New York City. Okay, that's cool. like you're really successful there. Well, the problem is when you expand to Phoenix, Arizona, you better let the people of Phoenix, Arizona know what you're doing, what you're up to. Like you gotta, market. So that's the thing with CAVA, if they can get their marketing more down, but the problem is the more you spend on marketing, well, shoot, it's going to be less profit for you, right? So, these are all things to factor in. So CAVA is just kind of a little bit of a messy situation. Their comp restaurant sales missed so bad that I just kind of put it, it's kind of like in the penalty box right now. This is kind of the way I would put it for that one, right? But it's a very intriguing long-term company, in my opinion, right? How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Let's get into this. Alrighty, folks, here's how to properly look at an income statement of a company, okay? Here's what you do. You start right off the bat looking at the revenue, okay? You want to see you need the company's revenue to be going up over time. That's a sign of a healthy company. The stronger the revenue growth is, the stronger likely the company's business model is, okay? So if we look at CAVA, strong revenue growth here, about 20%, okay? Great. That's a really, really positive sign right off the bat for CAVA. Not that many companies are growing their revenues like 20%. That's phenomenal, okay? Now from there, what you want to do is you want to look at how fast as a percent expenses are going up for a company. This is going to give you a good understanding if the let's call it the profitability is going to go up much more rapidly in the future if you're seeing a company's expenses go up at a much less percentage than revenues. Now keep in mind, if a company is growing expenses, let's say 20% and revenue 20%, the profitability of a company can still increase. You may say, well, how's that possible? 20% shouldn't just equal out? No. You know why? Because in most company situations, their revenues are a lot bigger than their expense profile. So even if you're growing expenses at the same exact percent you're growing revenue, for most companies that are profitable, like that's still going to mean you increase your profitability quite a bit, okay? But it's a really positive sign if, let's say, you're growing your revenues 20% and your expenses only go up 10%. Now we're talking about your margins are increasing rapidly, right? Now, if we look here, food, beverage, and packaging for the company was also up 20%. So they're not really getting any lift there, okay? Labor was up 19% versus revenues up 20%. So a little bit of lift when it comes to labor. Occupancy, they basically paid for their rents, right? 18% more, so that's good. They got some lift there. Now, other operating expenses, this was a little trouble area for the company. That was up 24% for the company on a year-over-year basis. So that's clearly an issue, right? It's growing at a much faster percentage than revenues. But overall, total restaurant operating expenses was up 20% for the company on a year-over-year basis, which, it's not impressive, right? Like they're basically growing expenses at the same exact percentage that they're growing revenue, which, means that you can still increase profitability, but it's not a great sign. Like you would like to see, ideally, these operating expenses be, growing at 17% or 16% or something like that, okay? Now, general and administrative expenses, that was not too crazy for the company. That is up, a decent amount on a year-over-year basis, but it's not a crazy amount considering you think about a company like CAVA, they're expanding all over the United States of America. You got to have a big team to pull something like that off, right? Depreciation and amortization, like that's just what it is as a base gets bigger of stores for CAVA, more equipment, all that sort of stuff. Like your depreciation and amortization is going to go up over time. So, that's nothing crazy in my opinion. That's just going to be what's going to be. Like depreciation and amortization should continue to go up for, the next 10, 20 years for CAVA overall. And it should increase quite a bit as they get more and more restaurants out there, right? Pre-opening costs also increased quite a bit for the company to $5 million from $3.3 million. You might look at that and like, geez, that's a crazy percentage. They're opening a lot of restaurants. It's to be understood, right? So total operating expenses to the company went up to 260 mil from 217 mil. So income from operations was still able to increase despite all these expenses going up pretty dramatically, right? So income from operations went to 19.6 million from 16.1 million. Okay, so good. That's good. Now, it's not great, but it's good. They're growing the income from operations, right? Now, they got some interest income here that went down a bit for them. If you look here at income before taxes, 23.7 million versus $20 million. Okay, solid, right? Solid growth there. If we look here, they have a major kind of, let's call it income tax hit of 5.3 million, where in this same quarter last year, they didn't have that hit. So actually their net income went down on a year-over-year basis. But to be fair, if this company didn't have this weird kind of like almost like non-existent tax hit here of $287,000 the same quarter last year, net income would have been up. Okay. Now, the next thing you want to do for somebody like a restaurant, you want to look at how much of that revenue actually makes it down to the bottom line. This is very important. Now, in the restaurant industry, 2 to 5% is very normal. If you go over 5% net margin and you're in the restaurant industry, that's a pretty good sign. If you go over 10% and you're in the restaurant industry, if you go over a 10% net margin, you're special. Like special. That's incredible because, it's just as anybody that's ever run a restaurant in their life, every single person will tell you it is a brutal industry. Don't get into that industry. It is brutal, right? Only the strongest of the strong survive. Like, it's tough, okay? So when we look at CAVA here, they actually have a decently impressive net income percentage, even though they're very young in their life cycle. So they're at 6.4%. That to me, diluted EPS came at 16 cents versus 17 cents the same quarter. That to me shows that CAVA could actually be one of the very special companies that not only could they expand all over the United States of America, but they might be able to get to double-digit net income as a company matures over the next, let's call it 10 years. So would I be surprised if CAVA eventually gets a net income percentage of 10, 12, or maybe even 14%? I wouldn't be surprised. And that puts them into a very special category. But you can't just assume that's going to for sure happen, right? There's always a potential that doesn't happen. So the overall, I would give CAVA's income statement here a C+ grade. It's got some very positive things like the revenue growth, right? Income from operations going up, but it also has some things where you would expect the profitability to be increasing at a faster clip than it is increasing, right? So I give them a C+ grade, borderline B- for CAVA here overall. Now, when it comes to these sorts of companies, you also want to look at their same store sales, and we're finding a very troubling trend. Now, you could broaden this out and say this might mean the economy is actually much weaker than the government data says, right? Because you look here and you look at CAVA's same-store sales. It went from 21.2%, shockingly great number, like growing same-store sales at 20% clip, oh my gosh, to then down to 10.8%, whoa, okay, it basically got chopped in half. Now down to 2.1% in the latest quarter, uh-oh. Now, if you just knew that, you might say, oh my gosh, like CAVA's got serious issues. Like what is going on with this company? These comps might go negative. There's something wrong with the company. You got to broaden it out. You got to look at competitors. And what we're going to find is Chipotle had a very similar phenomenon. They went from 5.4% positive comp to negative comp, 0.4% to negative 4% comp. Okay, so it's bigger than just CAVA, it's also Chipotle. Look at Sweetgreen. They went from 4% positive to negative 3.2% to this latest quarter, negative 7.2%, right? So when you see the Michigan consumer sentiment, right, and the consumer sentiment numbers being so trash last quarter, it shouldn't come as a shocking surprise. And this is why we track all this stuff. We do a report inside the private stock group each week, right, where we give you all the latest data for all these very important surveys. So you're not like caught off guard. And if you look at the data we've been showing you in regards to consumer sentiment last quarter, it basically showed you that these sorts of companies were likely not going to report a great quarter. Because if you looked at the consumer sentiment numbers, they were awful, just awful. And so when you see CAVA come in with such embarrassingly weak comps, when you see Chipotle's horrible numbers, Sweetgreen, it shouldn't come as a surprise at all. You're seeing it in the consumer sentiment numbers, right? So, but the thing you got to understand about this is consumer sentiment can change. A year from now, consumer sentiment could be in a whole different place, and CAVA could be reporting great comps again. Chipotle could be reporting great comps again. Sweetgreen could. So, do understand it moves around. In a year from now, this could be totally different comp profile, and we could be talking about, wow, CAVA looks great again, Chipotle looks great again, Sweetgreen looks great again. If it's not in a year from now, it could be 6 months from now. If it's not 6 months from now, it could be 2 years from now, right? So do keep that in mind. Now, the other thing that I would say is pretty impressive is the fact that Cheesecake Factory, their comps were actually up 1.2% for Cheesecake Factory brand in the quarter, right? When you look at how weak CAVA got there, the deceleration is shocking. When you look at Chipotle reporting negative comps, Sweetgreen negative 7.2%, and you look at Cheesecake up 1.2%, it looks like Cheesecake's doing very well for themselves. So then you have to start thinking, okay, let's say consumer confidence actually comes back significantly over the next year. Who knows if it does, but let's say it does. What are the comps going to be? Who's going to benefit the most from that, right? So that's something to kind of keep in mind. Now, this is a bigger point I got to make here around stock price, okay? Stock price and what would happen if the market was different, okay? Because this is very important everybody understands this, because one of the most scary things you can ever see in the stock market is when a company's stock price keeps going down massively while the stock market's going up. Not usually a great thing. That means the company either has like real true fundamental issues, or maybe they had some sort of valuation problem, or maybe it's like a turnaround type company, okay? So when we look at CAVA, okay, this company's stock price is down, basically has been cut in half in the past 6 months. It's down, 49.7%, so we can basically call it 50%. It's down in the past 6 months. That's extremely troubling, because when we think about the market, the Qs, right, which Qs you usually think about as kind of more growth-related stocks, right, the NASDAQ, the Qs, NASDAQ 100, 10% up the past 6 months. So the stock market's been good the past 6 months, up 10%, and you got a stock like CAVA that's been cut in half in the past 6 months, which makes you say, what would a stock like this be trading at if the market got hammered? And the answer to that is $30 to $40 a share. If this stock is that weak in this strong of a market, where the NASDAQ's up 10% in the past 6 months, whew, if the NASDAQ was getting hammered right now and the S&P 500 was getting hammered, this stock would be $30, $40 stock right now, okay? Which is scary, and that's why you have to be a little careful with buying into some of these companies that have higher valuations, right? Which when we check on CAVA's valuation, we're going to find here, which, I actually kind of like CAVA as a long-term investment, but I got to acknowledge the fact that this is a scary stock to invest in. Because look at the valuation of the stock. Forward P is 100 plus. 2-year forward P is just under 100, okay? So think about if, let's say, we get a major correction in the market, like this stock could fall another, 40 or 50% from here into that $30 to $40 range. If all of a sudden the S&P 500 NASDAQ got hammered in the fall time or winter time or something like that. And that's just something to factor in, and that's no fun. It's no fun to, buy a stock now, and then it goes, next thing you know, you're looking and you're down 40 or 50% on that stock. That's rough, right? When I go down like 20% on a stock, I'm like, oh man, we're getting hammered on this one, right? Go down 40, 50% on a new investment? Oh, brutal, man, brutal. So this is just something to kind of factor in here, okay? Now, for those of you that are looking to take things up to a higher level, you enjoyed that piece I just gave you there, right? You want to learn more about income statements, balance sheets, cash flows. If you're getting a great deal on a stock, if you're getting ripped off, if you enjoy that sort of stuff, if you enjoy what I just shared with you there, click the pinned comment down there, apply to join Private Stock Group, because what I just laid out for you there, that's what I'm going through in my course curriculums. I'm teaching all this higher level stuff so you can actually know this stuff on a high level, right? Be confident when you make investment decisions, not like, oh crap, I don't even know what I'm doing. I'm just gambling money around in the market, right? All these courses teach you all this stuff in depth. So if you enjoyed that part, you're going to definitely enjoy my Private Stock Group, right? You also get access to my Discord chat, access to 1000xstocks.com, which I just pulled up here for you guys, right? Access to see the stocks I'm buying and selling in my nearly $4 million Fidelity account now at this point in time, the public account, right? So how would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus
Discord community where we're constantly keeping in touch with each other, talking about what's going on in the market. How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area.
Next up here, Adobe Stock. This one has been a dog this year, right? Down 20% plus this year. Just the stock's in the gutter. People are like, yeah, now what's going on with this one? You know, here's the thing with Adobe. I mean, the stock's a buy. Like, I don't know what else to say. Like, the stock's a buy. Like, I run my projections on Adobe, and all it screams is buy, right? Listen, first off, in regards to the business model, before we get into the fundamentals, I think it's the same exact thing with that Google's going through right now. Everybody's all worried about, is there disruption in the business model, those sorts of things, right? And at the end of the day, what I've come back time and time again for with Google and with Adobe is some disruptions, yes, but they're new opportunities that it ends up just netting each other out. So I don't look at Google as like being hurt by this whole AI boom. I don't actually look at them as being helped that much. But if I was to say one or the other, I think they're actually helped more than hurt. Same exact thing with Adobe. Like Adobe might, there's some new competitors out there, things like that. I think they'll be hurt in some ways, but I think they'll also be helped in many other ways. And I think at the end of the day, like Adobe's going to end up being in a situation that they'll likely end up being more helped by AI than hurt by AI. And so with Adobe, I'm just like, this is a good company. It's going to be putting up good growth rates. So I ran projections on Adobe. And keep in mind, my projections are very modest here for Adobe. And at the end of the day, when you see these projections I run, you come back with a conclusion that Adobe's a buy right now. Like not tomorrow, not today, like right now. Like this exact second. It's a buy. And here's why. Okay, here's my modest projections. My bull case for Adobe, my bull case I ran on 1000xstocks.com, okay, has them doing 10% revenue growth per year, 2026 to 2029. That is not a crazy number at all for a bull case. That's very modest. I've been doing net income growth of 12% per year. That is not a big number for Adobe at all. Okay, this is extremely conservative bull case for Adobe. If they're growing top line 10%, bottom line 12% a year, right? And 25 to 30 P is very fair. You can make an argument that it should be in the 30s, given that it's more of a SaaS play. But once again, I even took the more conservative route with P ratios, 25 to 30, okay? And what do we get? By 2029, we got a compounded annual growth rate on the low end of 21% and 27% on the high end, which gives me, we can call it a midpoint CAGR, about 24%. On an extremely conservative bull case, I got to buy that stock. My base case, this is the one I expect the most highly probability of essentially happening, right? Look at this. I have them doing 8% revenue growth per year. 8%. Put me to sleep, okay? For Adobe, that's nothing. I have them doing 10% net income growth per year, right? If they're growing top line 8%, bottom line 10%, a 23 to 28 PE ratios, easy peasy lemon squeezy. And what do I get? I get a stock price somewhere between $633 and $771 in 2029. That gives me a compounded annual growth rate on the low end of 17%. And on the high end, 23%. We can say midpoint 20% CAGR for a base case that is very conservative. I've got to take that opportunity. Like, you give me a CAGR likely of 20% on a very conservative base case for a great established company in the SaaS space. I can't just sit on my hands and be like, no, I'm not going to buy that. Yeah, I'm buying Adobe across my portfolios right now, right? Buying into my private portfolios as well, because I'm like, give it to me. Give it to me. No, my bear case is, let's say, they're extremely hurt by competition. Extremely hurt, right? So they're only able to produce 2% revenue growth per year over the next several years, and only 2% net income growth per year. Like, they really got hammered by the competitors and had trouble growing their business. Like 2% growth for Adobe? What are we talking about here? This is a disaster. I put them at a 15P ratio for this case, a 15P ratio. And what do I get? A negative 3% CAGR. come 2029, right? So basically, I lose a very slight amount of money. It's more the opportunity cost if that bear case was to play out. But I don't, that bear case I would say is probably a 10% probability that plays out. So I'm going to take the 75% odds probability, which is his base case, which gives me a CAGR of 20% over the next few years. Like, I don't know what else to say. Easy.